to see, because I can see who's popping into the waiting room. It's great to see the names of our alumni. So good to have you. So this is day 2 of a 5-day alumni conference, alumni of the Exeter MBA, alongside current cohort from the Exeter MBA. And our intention across the 5 days is to provoke some new thinking, give you some insights on the latest that's happening in research and in the professional world, to create dialogues and to get you connected and reconnected to each other. So LinkedIn is a favorite platform, and we're often on there and sharing the posts that our alumni place, which is absolutely great. Yesterday, we set up a Padlet with a map on there of where you all are in the world. So I put the link back into the chat for you now. So at your own time and pace, pop in where you are, give us some background and a photograph, and it's all intended to stimulate that alumni community and keep us connected to each other. So today I'm delighted that the focus of our session is sustainable finance, how financial markets will drive the corporate world to fulfill its promises and respond to the cries for change. The format is that I'm going to hand over in a second to our guests from Refinitiv for about 60 minutes, and then they will open up to Q&As from the audience. So I'm delighted to introduce you to Ryan Sheppard. Ryan is Head of Content Strategy and Development for Refinitiv. He is a real friend of the MBA and sits on our advisory board. We take lots from his creativity and his insights, so thank you, Ryan. And Ryan is going to be in conversation with Elena Philipova. Elena is Global Head of ESG Proposition for Refinitiv, and they're going to have a dialogue around this whole subject of sustainable finance. Ryan, I'm going to hand over to you. Thank you.
Thanks, Jackie, and thank you to the MBA team for having Elena and I on board. Exactly as you say, our subject is this whole area of sustainable finance, huge growing area, and I'm going to be looking at the role of finance driving the corporate world to fulfill its promises. I'm Ryan Sheppard. I've now been with this company in its various guises for around 20 years, which is a heck of a long time. I'm responsible for the marketing content and strategy for the company. So it's my job to produce really valuable and engaging content for the financial community that gets them to discover who we are as a company and ultimately takes them a little bit deeper into the company to discover what we can do to help them meet their challenges. I'm lucky enough that I was based in Switzerland for 4 years. And back in I think it was about 2014, Elena, small team of us there in Switzerland decided it was time that we developed a sustainable presence for the company. So we built a website and brought in loads of strands of content from across this big company. And we had plenty to play with. We had all the legal business and the financial business. And we also had Reuters News as well. So we brought all this great content and data and expertise into one place. And that was the sort of start of the sustainability presence for Thomson Reuters. And I was lucky enough to work with Elena back then, who is based in Switzerland, and that was pretty good fun and one of my favorite projects that I've worked on. But I'm so happy to have Elena here with me today because Elena is the absolute resident expert in sustainable finance and all things to do with ESG. Elena is the global head of ESG proposition at Refinitiv, and she's been in the sustainable finance industry for over 15 years. She's responsible for the end-to-end management of our ESG business, our products and services, and that's global. She was the rapporteur for the benchmarks group of the EU Technical Expert Group on Sustainable Finance, which was appointed by the European Commission, and she provided all the technical market expertise to inform sustainable finance regulation for the EU and beyond. So I think you get a sense there that she's incredibly qualified to be part of this conversation today. But I'll lead off, and then what I'll do is I'll sort of ask Elena questions as we go along, so we all sort of benefit from her deep expertise. I'll just use the little arrows. What the heck? Okay, just a little bit about the company, so you know where we're coming from. Refinitiv is actually formerly the financial and risk business of Thomson Reuters, and we're a world-leading data and technology business. So we supply data, insights, technology, and expertise to almost every part of the financial community. That's up to 176 billion market messages every day, which seems just remarkable, even to me, from 150,000 data sources. And we serve over 40,000 institutions in 190 countries. We're in a good place with what we do. Markets are growing, are moving faster, and companies want to harness the exponential growth in data. They have an insatiable appetite for data, and we strive to meet that demand. And as a company, we can piece together disparate data sources, whether it's from automated or manual data sources, on almost every subject. And then the environmental, social, and governance data, that's ESG, which you hear a lot about in this whole speech, is a really rapidly growing area for us. And it's actually been exploding even further with the COVID pandemic. We've seen a big increase in the number of queries and the usage of our ESG data in recent months. And that ESG data covers more than 10,000 global companies and represents over 80% of the global market cap. So that's a little bit of background. Bit of news, breaking news, and something very exciting that I'm head first into at the moment is that we are soon to be become the London Stock Exchange Group, and on Friday, in fact, all things being good with regulatory clearances and that sort of thing. So it's very interesting for me because I'm going from a brand that's just over 1 year old that no one really knows to a brand that almost no one doesn't know. So it's quite a transition for me and the whole company, really, but an exciting one. The combined company's purpose will be driving financial stability, empowering economies, and enabling customers to create sustainable growth. And I think that's important just to flag that right out of the blocks, this combination of Refinitiv and the London Stock Exchange has that sustainability agenda right up top as a part of our key purpose. So what does it actually mean? Well, London Stock Exchange Group has a whole range of assets and capabilities in sustainable finance themselves. They have the FTSE Russell indices. They're pioneers actually of ESG indices. They have global capabilities in fixed income, such as government bonds. So the London Stock Exchange is actually a major destination for green bonds, which are incredibly important. And then you combine that with all our data sources that I mentioned, ESG data. We have the world's biggest infrastructure resource where we have information on all global infrastructure projects, or the majority. We have our commodities, our trading, our carbon prices business. So when you bring together that set of capabilities, it's really quite powerful in sustainable finance because we've got the indices, the data, the analytics, the infrastructure, the green bonds. And so it's a real powerful package to help our customers and the financial community to really push forward the whole sustainable finance agenda in the months and years ahead. So that's kind of exciting for us to be combined. So that's all to come in Friday and the week ahead. Kind of exciting. So this will be our agenda. We'll have a quick introduction to sustainable finance. We'll look at the scale of the problem with climate change and the urgency behind that. Who can solve the problem? Where's the money going to come from? The role of financial markets. And then we'll look at where next and take questions. So it should be about an hour, I think, and then some time for questions afterwards. I don't think we can go on for much more than an hour and a half. My colleague Elena has just recently had a baby, so she's juggling some home care things there. I think she's got the grandparents in, but we'll see how we go. I'm very grateful for her to be able to join us. So let's jump straight in. introduction to sustainable finance itself. So it goes under many, many different terms. Sustainable finance, it is ESG, sustainable investing, also called impact investing, transitional finance. The European Commission definition is that sustainable finance generally refers to the process of taking due account of environmental, social, and governance considerations when making investment decisions in the financial sector. Makes perfect sense. Social considerations may refer to things like inequality, inclusiveness, labor regulations, investment in human capital and communities. The governance part of it, with public and private institutions, includes management structures, employee relations, executive remuneration. So in general, as I say on the slide here, we see sustainable finance has two main goals. One is that the funding of global decarbonization of the economy, prevent irreversible and catastrophic climate change, and also has a role in ensuring businesses adopt the values of open society in which they operate. Here you've got a breakdown of that all-important ESG data, so you can see the kind of data that combines together. And at this stage, I'd just like to throw a question across to Elena, bring her on board, and just ask Elena, what really is the history of ESG, and how did you get involved, Elena, in the whole field of ESG and sustainable finance in the first place?
Thanks, Ryan, and hello everyone. I hope you can hear me okay.
Yes, we can hear you.
Okay, that's great. Although yes, you're right. There's been a lot of momentum and talk about sustainable finance, ESG, in recent months and years. ESG, or the field, is not new to the industry. It actually goes back decades to what was called faith-based investing, where because of religious beliefs, investors would exclude certain industries or certain companies from their investable universes and portfolios to meet those religious views. That then expanded into a practice called negative screening. About 20 years ago, the industry, or this approach of investing, was termed as socially responsible investing, where it was more also ethical investing, but in terms of exclusion, was again still the most primary investment strategy adopted. And now, 10 years ago, that's the time I entered this industry. That's when the term ESG started being coined out to illustrate and summarize a different way of approaching investing, where you account and not only exclude industries which do not align with an investor belief or needs, but you also start looking at more creative ways to engage with the industry, with potential companies or assets to invest in, to drive positive outcome and better assess not only the risks that ESG considerations present on investable opportunities, but also the upside. Engage with companies to drive long-term value and have that positive, not only ESG outcomes that investors are looking for, but of course, more importantly, financial outperformance. And in recent years, we hear actually another term being used more frequently in terms of impact, in terms of sustainable finance and investing. So really bringing the concepts into mainstream financial decision-making workflows and processes. And I actually come with a background in finance. I did my major in finance back many years ago in the States. I worked as an equity research analyst, but to me, the way that financial markets worked at that point in time seemed quite inefficient, quite superficial. And sustainable finance and ESG was really the answer that I was looking for. And I was immediately drawn to this space as the answer to have and mobilize the power of the financial industry to not only generate financial long-term growth, but actually also generate environmental and social opportunities and have a positive impact with the capital that is held both by the public and the private sectors. So it has been my passion and my mission for 15 years to drive that change into financial markets.
Thanks, Elena, for that intro. So just to talk about the rise of sustainable finance, there has been a huge growth in sustainable finance in 2020, particularly looking at the trends in social bonds and green bonds, sustainable lending and equity and capital markets. And you can see some of the growth here. AUM is assets under management, by the way, as part of that table. So there's really not one single part of the whole financial services industry that isn't impacted, that's not going to be affected by this growth in sustainable finance. And Elena, back to you. I just wonder, why is it running so hot right now, particularly since the outbreak of the pandemic?
I think there are different reasons for that, Ryan. And you're absolutely right. I do recollect at the beginning of last year, at the beginning of 2020, at the start of this quite unexpected period that changed our lives in ways that nobody imagined before it started. There was a lot of skepticism around sustainable finance, mainly because industries, not only companies, but whole industries and economies were realizing that they were on the verge of fighting and struggling to survive. So there was that skepticism in the marketplace, which proved to be absolutely not valid and not true. What happened last year was what I classify as the year of A's. Maybe we're starting a new phase for society. It's the acceleration in action around sustainable finance. It's the appreciation of how fragile our society is and our economy, and the aspiration to bounce forward rather than bounce back to a better world. Build back better phrase that's been coined out last year and used quite effectively. I think that this is how I would classify what happened since the outbreak of the pandemic. We see really a big mobilization by regulators as well as the private sector, putting forward very bold commitments to sustainable finance, specifically around net zero, around decarbonizing economy, creating competencies, standardization, and very urgent commitments to.
As a company, we gather data, ESG data, from many different sources. I think we've got a team of about 180 people who are constantly scouring all sources of ESG data on companies. And we create this ESG scoring system. And the whole purpose of this really is to create transparency around a company's relative ESG performance compared to their competitors in their space. So this is an example of tests. Surprising to me, and it might be to other people, you'd think that Tesla would have an incredible score, ESG score as a company, doing what they do, producing battery-powered cars. You think they'd be in one of the top 10, but actually the score isn't that amazing. In truth, and that's because there are some other factors such as their workforce score, the human rights there, as you can see, is not so great. They source an awful lot of lithium from mines which aren't very well regulated, and I'm looking after people. I know Elena could go into this in massive detail, but I think this is an important part of what we do as a company. Is there's that saying, isn't there? You what gets measured actually corresponds to action being taken. So we're gathering all these disparate sources and throwing it into a very simple visual where a company can go in and take a look and see how they're performing. Sorry about that, everybody. Little technical glitches. I've had dogs knocking down doors and everything whilst we've been gone, but we're back. Ellen, you were just talking particularly about the COVID pandemic and the impact on sustainable finance. What a wake-up call it's been.
That's right. And yeah, apologies for the short break, but I'm told my audio is a lot better. So hopefully that's a good change and a good pause. Um, but yeah, just to pick up where I think I got cut off, I was mentioning about the year of A's and the acceleration in action, the bold commitments we've seen both from the public and the private sector in terms of carbon neutrality and decarbonizing the economy. We're going to speak a lot more in detail about all of these different points during the session today, and hopefully you can also steer us in a direction through your questions to go deep into all of these areas, because there is a lot more to be discussed around every single piece that I mentioned. But both a lot of governments from all jurisdictions have put forward very bold commitments, not only around the climate agenda, but around the sustainable agenda, because COVID and the pandemic really shone a light on the importance of not leaving behind the social dimension of ESG. We've seen in recent years a lot more work happening around understanding climate risks as well as opportunities and what that means to investing and financial decisions. We've seen the creation of the TCFD standards and the push towards more transparency, but we don't have an equivalent around the remaining environmental issues and topics. And when we move into the social dimension, it's even less defined and understood by the market. It's a lot more soft. It's a soft topic. It's a lot more difficult to quantify and measure from a financial perspective. So there is this appreciation of the importance to really tackle the challenges in understanding that they're very much interconnected and interdependent. From a private sector perspective, we also seen a call out to mobilize action to work towards standardization and common definitions, starting with the ESG standard setters, but also with traditional financial standards organizations like the IFRS, consultation on what role they should play around sustainable investing, the IOSCO initiative, the World Economic Forum, and the collaboration that they've had since more than a year ago now with the 4 accounting firms on defining standardized ESG metrics. And the list goes on and on and on. There is just so much momentum in the industry. The second dimension is around appreciation of the fragility of our economy. And there's been, again, I think, more awareness around climate change. And the IPCC, the Intergovernmental Panel on Climate Change, reported that cumulative damages from climate change could reach more than 8 trillion by 2030. So the cost of climate change, vast majority of which is currently not at all priced in the markets, are relatively well understood, and they're frightening. But the pandemic has elevated the urgency around scale of action and the speed of action. Again, not only on climate, but other environmental issues, the social as well as the economic risks presented to our society. It really has illustrated how interconnected those issues are and the urgency to act. And in terms of aspiration, the third A that I mentioned, this is about the phrase that's been coined out last year around Build Back Better. It's the necessity, not really the desire, but it's the necessity to bounce back better, to bounce forward, as I like to say. And that's what resilience to me means. Resilience means after big disruptions, you redefine the new normal, you redefine the way that the course of action on a go-forward basis, not try to replicate where you're coming from, but rather learn from this setback and accelerate. And this necessity of change is very important because what we've entered is a century of volatility. There is a lot of scientific consensus that the current pandemic is not an isolated case. It's not going to be the last. There will be a series of different disruptions, volatility that will be hitting our society, our economy, and we need to build resilience back in our systems, in our behaviors as consumers, as individuals. This is not a problem for the governments to solve only. It's not a problem for capital markets to solve. It is a problem that every one of us has a critical role to play into. Ryan, back to you.
Thanks, Elena. Wow, you come back strong, and it's so good that your sound is better now, so we can really catch exactly what you're saying. It's fantastic. I was talking about the scoring that we do and how it creates this transparency of companies so they can see how they're performing on ESG scoring relative to their competitors in their space. And I was just saying that Tesla always comes as a bit of a surprise. I just wondered if you could put a bit of context around that, why Tesla isn't as great a performer as you might think.
Yeah, and maybe it does make sense to just mention a couple of words about Refinitiv and our position around ESG and what role do we play in the market to empower more informed investment decisions from an ESG perspective. Refinitiv, through its reiterations, is previously Thomson Reuters and previously Asset4, which is how we started building out the ESG services and propositions into our mainstream products and solutions. We've really taken a stand 15 years ago that ESG is part of mainstream financial decisions and markets. It shouldn't be something that is done on the side as a nice to have, a differentiated product or a fund. Rather, those issues are financially material. Different issues are financially material for these different industries and companies, but they are financially material to every and any investment decision being made across different asset classes, whether that's advising on an M&A deal, financing an infrastructure project somewhere, investing in equity or fixed income or government bonds. If investors do not assess the relevant ESG risks in their processes and workflows, they're arguably not fulfilling their fiduciary duties because they are knowingly avoiding very material and critical financial risks and considerations. So this, we believe, is quite important, and it is visible in our products, in our propositions, and our offerings. And the approach we've taken also in terms of scoring is one where it creates a framework of a data-driven framework, which is factual, which is objective, and it's complementary to financial factors and considerations that users and investors would normally take into account. The other point that's worth mentioning is it's always very tricky to combine E, S, and G. What we're talking about are vastly different issues, and they all really have different factors that go behind them, as well as methodologies that should be built into the process to assess where the relevant risks and opportunities lie. When we talk about the environment, as mentioned, we talk about climate change, and there we really talk, what investors are looking for right now is assessing the physical as well as the transition risks that sit within their portfolios. So it's not only about, well, let's create a climate product which invests into a low carbon set of industries or companies. Because what that actually means is greenwashing. You're taking capital away from the sectors that are most desperately needing investments to drive change. It's about, again, understanding those risks and opportunities at the heart of financial decisions. And there are very different nuances to them. Social can mean quite a lot of different things to different investors and customers, depending on the objective that they have, the mandate that they're fulfilling for, let's say, an asset owner or a retail investor, if we're talking about wealth managers and so on. And governance is really underpinning, and it is at the heart and the foundation of everything. This defines the framework of how companies individuals are responding to environmental and social and financial risks and opportunities that these companies, for example, are facing. So bringing in these different issues can create a lot of different signals and insights to investors. And that's at the heart of one of the problems that the industry faces around low correlations across ESG ratings provided in the market. There are many different approaches that can be taken. And if one rating puts more emphasis on environmental performance and the capabilities that companies are bringing to market to fight climate change, then a company like Tesla would get a much higher rating. If a rating is putting more emphasis or a more balanced approach around, well, it's great that some businesses have positive impact on one aspect like climate, but we cannot overlook the impact that they have in other aspects like social, like human rights or supply chain or governance and conflict of interest, for example. If a rating is applying a more balanced view on those different impacts that a business has, then a company like Tesla will get a lower score. The Refinitiv ESG scoring is very balanced. And this is the default framework of how tens of thousands of customers will first experience the ESG profile of companies when going into our products. They will see a very balanced view across the full dimension of environmental, social governance, as well as financial profiles of the businesses. And then they can tweak it based on their individual values, individual mandates and needs. If they are fulfilling a mandate where climate change is most important, they will overweight the performance rating of a company in climate change and underweight in other topics and issues. So there is a lot of flexibility of how investors actually then take this wealth of information to make it align and meet their individual needs. So that's a little bit of a long-winded answer there to a very specific question, Ryan, but I think that having a bit of a context is helpful.
Yeah, it's fabulous context, Elena. Thank you. I was actually learning a little bit there as well whilst you were speaking. It's very good. So let's look at the next section was about the scale of the problem. I don't think I need to, with this group, go into this in any great detail. I think it's a very, educated group who understand that we are facing a tipping point on climate. You know about the Paris Agreement, the way forward on climate change, pushing countries to reduce their carbon output, to reduce global warming to below 2 degrees. And now we're in that second decisive decade, I guess, in history, where we need to take concrete action to meet the goals. And over 100 countries have pledged to achieve net zero greenhouse gas emissions. There's all the sort of good news, and I'm delighted with Joe Biden's inauguration, pushing forward back with the Paris Agreement. So, as Elena was mentioning, it's been an interesting year with COVID-19, an interesting social experiment in sustainability, because it's such a good example of what it's like to do next to nothing, a lot less in our lives. So by the end of the year, carbon emissions will be down. I guess this was looking back at 2020, actually. Carbon emissions down by about 5% due to COVID emissions. But the Paris Agreement is calling for a reduction in carbon emissions of 7%. So if you think about it, that's pretty amazing. Even doing less in a totally untenable way, like we have been for the last year, we're still not getting where we need to be in terms of emissions and where the world needs to get. So Elena, just back to you. I just wondered, did you think company execs are fully woken up to the issue and the scale of the problem that we face?
Yeah, I mean, I'll pick on your last comment, and I think exactly doing less the same way is far from being the right answer. It's not sustainable. It's not going to deliver the needed change. What is really required is a fundamentally different business model, economic model, systems, behaviors, as mentioned. And I I do believe that there is certainly a lot more appreciation and awareness that that's the case in terms of very concrete actions that we've seen and bold commitments coming out last year from numerous governments, from large organizations, investors, asset owners. The full value chain has been mobilizing and being vocal around how they can be part of the solution rather than part of the problem. I think the bigger challenge is it's great to know that needs to happen, but how does it happen? I mean, how do you actually create a new system, a new model that will deliver the change and the scale of change that's needed very quickly? Because it's really very disruptive moment for the whole economy, and with any disruption that creates a great sense of uncertainty, a lot of pushback, a lot of fear in the market, and I think that's what we've experienced in the last 12 months. At the same time, a lot of leadership and answers that actually, to start solving the problem, we do need more information. Data equals accountability. Data equals action, and it enables you to turn change from a fearful event into a very exciting market opportunity. And we see a lot of market participants actually embracing this opportunity, as this is what will create the economic growth that's so needed for our society and our economy to recover. We've also seen, from a corporate perspective, many businesses actually transforming themselves, most of the time from the top down, but fundamentally transforming their businesses to be sustainable and moving away from being involved in activities and industries that simply do not have a place to play in a sustainable model, into brand new fields and areas. And the most interesting thing is that such businesses are very much delivering immediate financial outperformance. So it is not only the right thing to do in the long run, it's transforming the models to be sustainable is the only way to sustain economic and financial growth, even in the short term. One such example is the Italian company called Enel. It's a large utility company. They used to have 100%, I believe, fossil fuel production plants and facilities. They're currently one of the most sustainable utility companies, transformed to renewable energy sources a couple of years ago, and have delivered superior financial results as well for its investors and stakeholders. So I think that that's the other key message that the pandemic has sent to all of us, is the necessity to shift and consider environmental and social recovery as a prerequisite for economic growth and building back the economy.
Thanks, Elena. And then I wanted to just touch on biodiversity, actually, because it's almost like a forgotten topic, certainly not getting the sort of coverage that it should do when we're actually facing like a sixth mass extinction. You can see some key quotes here: a suicidal war on nature. And yet nature underpins our whole prosperity and well-being, because it gives us that economic value and security, supports human development and equality, and increases our resilience to climate change. This little graphic that I've pulled up, I just found absolutely fascinating and kind of horrifying. This is the number of plastic bottles. Over 1 million plastic bottles are purchased every minute. And this graphic shows the plastic bottle mountain of 4 trillion bottles over the last 10 years, compared to the sort of New York, Manhattan landscape. Pretty bloody horrifying. And Elena, why do you think that the biodiversity isn't getting the sort of attention that it deserves, and what can be done about that?
Yeah, you're absolutely right, Ryan, to call that out. And as I mentioned, I think that the area that has received most attention in recent years has been climate. And that's quite understandable because climate is the most urgent, evident, economically harmful topic that the society is feeling and paying for, and has been paying for, and therefore has mobilized more work around it. However, what we've realized with the break of the pandemic is how intimately interconnected biodiversity, deforestation, climate change, and societal challenges actually are, and how detrimental it is to create solution in one area, but overlooking the implications they have in other areas. So what we've seen is quite a lot more work now in the industry around starting to assess biodiversity from a financial perspective. I believe that this area is a couple of years behind from climate and climate assessment and understanding from a financial standpoint of view. So it will not happen overnight, but hopefully we can learn some lessons from our journey in terms of quantifying climate implications for investors and from a financial perspective. And I guess one quite obvious example in the industry that's the journey we're on is the creation of the TNFD, the Task Force on Nature-Related Financial Disclosure, which is very similar to the Task Force on Climate-Related Financial Disclosure, or TCFD, which was established a couple of years ago. It's put forward recommendations on how should climate be assessed from a financial perspective, what information companies need to track consistently, systematically, and report to all of their stakeholders, including investors, so that they can have a more accurate view on how to quantify and price climate risk into investment decisions. And this task force is actually aiming, the TNFD is aiming to do the same for biodiversity. We started seeing already a few years ago a lot more appetite in the market around biodiversity data and ways to assess risks from the investment industry. We've also seen the creation of different coalitions and alliances from asset managers, leading asset managers, to push the industry towards acceleration and better definition. But again, at the end of the day, I guess I would emphasize that the biggest problem is data. And not data because we don't have data. There is a lot of data out there, but data in the sense of standardized and readily available information, which is following consistent definitional principles and taxonomies. It's the standards that is missing. And this is what TCFD aimed to solve for climate. And this is what TNFD is aiming to solve for from a biodiversity standpoint of view.
Thank you, Elena. Okay. So that's great. We covered off the size of the issue, climate and biodiversity. So let's start to look at, what we can possibly do to solve the problem. And in particular, this question about where the money can come from. I'm sort of aware of time because we were at this stage, I think, planning to get into some questions, and we're still quite a long way through. So I might sort of whiz a little bit through some of these sections. I would like to ask you about governments in particular, though, Elena. We know they're stepping up. The EU and China, they're pledging to be net zero for 2050 and 2060. And now we have the impetus coming back to the States, thank God. There's hope for COP26 in Glasgow next year. But, there are difficulties. We can't expect everything to be in the hands of governments because they lack the resources and short-term electoral cycles, spiraling debts to consider after the pandemic, and maybe the will and urgency in some cases is not there to do what's required. But Ellen, you're very close to this, and you've done a lot of work with government regulators in particular. What challenges do you see them facing to drive the agenda for financial markets and economic growth?
I guess so. Let me start off by just mentioning that the role that the European regulators, and specifically the European Commission, has determined and decided to play in this agenda is a leading role. And by far, what has been produced so far by the European regulators is the most comprehensive action plan on mobilizing both public and private capital and shifting it towards a sustainable economy. And this is guided by the Action Plan on Sustainable Finance, which was published already back in 2018. It's a result of the high-level expert group recommendations that were created post signing the Paris Agreement. There are endless challenges, and I think that simply illustrates how complex the challenge, the problem we're trying to solve is. In terms of definitional challenges, sequential challenges, we're really looking to redesign how the whole economy works. That cannot happen overnight. It will normally, in normal cycles, it will take decades, but we don't have decades. The pressures that the environment has put on our economy, on our society, require and demand very urgent and quick actions. And therefore, so you on one hand have pressures to immediately act. On the other hand, you're really trying to solve for a problem that requires a lot more long-term work and redesigning and sequencing the right initiatives in the right order. And you simply don't have the luxury to do that. I think that that's the main challenge that regulators are facing. Lack of expertise makes it even more harder because this area and topic is relatively immature, although it's been around for a very long time. It's immature in terms of definitions and understanding of how to quantify what it means in terms of implications to different market participants and so on. I think that what especially European regulators, but broadly speaking globally, all governments are realizing that to meet their social and environmental commitments as outlined by the United Nations Sustainable Development Goals, the 17 SDGs, which all nations have signed up to, in addition to the Paris Agreement, you do need a substantial amount of capital. The good news is that the capital is available. There is plenty of capital out there. The question is, how do you take the capital and identify where to direct it to have the desired impacts? So it is not a question about more money that needs to be printed or more buy-in from different market participants. It's a question around linking investable assets like companies, infrastructure projects, bonds, and so on, to actual impact on the ground. So if I invest in company ABC, how much actual real life impact is this going to have for me as an investor, for me as a human, or for any one government that's trying to fulfill a social or environmental objective? So it's a definitional challenge more so than anything else. But to finance that shift, the private sector plays a critical role. The public sector money alone cannot finance the change to sustainable economic model. The public sector needs to work hand in hand with the private sector. And that's where you get a lot of work that regulators are trying to do to empower the private sector as well to be able to channel capital in that direction. Because the challenge that I mentioned is even more so present for private capital. How to identify the assets, the investable assets that can generate that desired positive impact. And regulators, especially here in Europe, have been looking at ways or tools that they can give to the market to enable them to then make those investment decisions. Things like the EU taxonomy. What is the EU taxonomy? It's a classification schema that looks at the economy and says which activities generate substantial environmental positive impact and which activities do not. How do you do that? I mean, let's take an industry as an example, an automobile producer. Who is green and who is not? Are hybrid vehicles green or not? For some investors today, they are. For others, they're not. And that's at the heart of the problem. There are no consistent definitions, and everyone is adopting their own definitions, and that leaves a lot of room for greenwashing. Regulators need to step in and bring that clarity to the market, those consistent definitions, and say, for any company that produces automobiles, an automobile, a unit of production, can be considered green if it emits 50 kilograms of CO2 emissions, let's say per 100 kilometers. Give a specific technical guideline. And this is what the taxonomy is doing, providing those technical guidelines to be able to consistently say which economic activities are green. And this is only step one of overcoming the problem. We're talking about climate, then we need to start looking into biodiversity. How do you quantify impact of economic activities and businesses on biodiversity, on circular economy, on oceans and water preservation, minimizing pollution, or then look at the social. And we're only currently talking about positive impact. What about the bad guys? We need a brown taxonomy as well. This first step of the EU taxonomy has taken the European Commission to create close to 2.5 years, and hundreds of very deep industry experts working very hard to define those criteria and technical standards. So to overcome the definitional challenge is a very timely and cost-effective process. And I would probably say that that's the biggest challenge for regulators to overcome.
Right, thank you, Elena. I think we've covered quite a bit of ground that we're going to bring out in the rest of the presentation, and I'm keen to give people a chance to ask some questions because I feel like there'll be quite a lot of questions out there. So the other group we were looking at, and I'm going to whiz a little bit now, was consumers. We have seen huge shifts in behavior. I saw some results from this Ipsos Mori survey that said that there's the highest spontaneous concern about climate change. But in the same survey, despite those warm words, only 9% feel it's their responsibility in tackling climate change. And again, that point that even when consumers have been at home and inactive, we still haven't lowered CO2 emissions to required levels. So not just the answer with consumers. And then looking at corporations themselves, there is this realization. I think Ellen's been talking about, had some great examples there. They can't just divest and diversify their way out of these issues. Lots of companies, though, are setting net zero targets. Even companies like BP are out there seeming to be doing the right things, making big changes. But then for every Microsoft pledging to go carbon negative, dozens more are doing nothing or actually increasing their emissions. There's a black hole. So, in our databases, out of 39 freight and container firms, which are huge emitters, have a huge impact, only 18 have disclosed their scope 1, the very closest level of emissions, and only half of the 10,000 companies in our database, nearly half, don't disclose CO2 emissions data. So there's a big gap there. There's no two ways about it. I thought I'd show this quick. I wonder if we have time. I'm thinking that
I might,
people
yeah.
can.
Yeah, thanks, Ryan.
People might want to check this out later on. It's available. It's a whole video showing the level of CO2 emissions from companies and how we've basically got a long way to go, even with those top S&P 500 corporations. The role of financial markets. Okay, this is getting to the meat of the piece. So funding those sustainable development goals require another 6.9 trillion is the OECD estimate of sustainable infrastructure projects. 1/3 of the 34,000 projects in our database are renewable, which is great. But unfortunately, then you look at the 62 trillion worth of projects, only 2 trillion or 3% are actually renewable. So decarbonizing the global economy is going to require an extra $3 to $5 trillion. Okay, so what's the role of financial markets? So we're saying that with the right incentives, only the financial system can really generate the sums that are needed to put us on this path to sustainable future. Exactly as Elena said, there's capital out there, there's money out there, but it's going to require a rewiring of the financial system, which is currently happening. Elena, I was going to hand across to you at this stage, but I think we really, really are just going to push on now. I wanted to just flash up. This is a very important area, which is actually what we've termed as a company the carbon correction. So basically, we calculated back in January that all companies have to pay for their emissions. And if the price was increased to $75 a ton of carbon, up from, I'm not sure, Ellen, what is it currently? $18, $20 per ton?
It's different jurisdictions, but
okay, different jurisdictions.
Yeah.
But the IMF said it needs to be around $75 a ton to keep global warming below 1.5 degrees. That means global business is going to be looking at a $4 trillion bill going forwards. So this is an incredibly important area and something that we're tracking very closely as a company. Again, I have to push on. Technology is going to be incredibly important. Fintechs have a key role in this part. And we're seeing some great technologies coming through, connecting consumers to funding of sustainable projects, giving people control of their finance so they can invest in areas that are in line with their own values, smartphones, data. It's becoming a lot cheaper to give that sort of granular control over people's finances so they can make those ESG decisions. So that's a key area to consider. And I think we have now reached the end. Sorry, we had a 10-minute break in there, but just in summary, governments are going to be incredibly important into where we take sustainable finance next in terms of incentives, and the role of the regulators, as Elena was talking about, essential to provide that mechanism to solve the climate crisis. But there is that real need for better data. And there's a lot of opportunity for technology and fintechs as part of that. Elena, maybe you can wrap up for us before we go to questions and just give us your view on the future and sustainable finance. And do you feel positive about where we're going and how we're going to get there? Big question.
A quick answer, yes, I feel extremely positive, most positive that I've ever been since I'm active in this space. Okay, are we going to get there as quickly as needed? That's the big question. But what's clear is that shift cannot happen without better definition, standards, and data. And this is currently at the top of the priority of everyone's agenda. I see lots of great questions actually coming through, so maybe we can jump onto those, and let me pick one, Ryan, while you can take a look at the other ones. The first one that came through was, does Refinitiv partner with regulators to hold companies accountable, and how can data that we have and the market has been used to drive accountability? I think that's an excellent question, because here we're really looking to drive accountability. This has been the problem. I mean, how can you hold anyone accountable if you don't have the data. It's so easy to have excuses and say, well, we didn't know. We didn't know we're investing in companies whose supply chain is suffering from child labor violations and other human rights issues. So regulators have a fundamental role in defining those standards, pushing for mandatory transparency so that then everyone along the food chain can be held accountable. Right now, the group that holds companies accountable are asset managers and asset owners. They are the ones that have the influence. They are the ones that invest and finance these organizations, these projects, and they can, and many actually do already hold businesses accountable for their actions or lack of actions. Whether that's through engagement practices, divestment investment strategies, or others. When the capital is taken away from the businesses, they're ultimately being hurt the most. And Refinitiv plays, of course, a big role in offering the data. We've worked with regulators, as mentioned, for years to inform the regulatory agenda, to empower it and make it align with the current reality so that it's informed by actually where data is today, where are the gaps. There are lots of data gaps, and that's what makes accountability quite challenging. But regulation in its initial phase is looking to improve transparency, and later on can look into accountability, penalties, incentives. That's not planned initially, simply because there is no enough data to drive the market.
Good. I thought you'd frozen a little second there. And are there any other questions? Was it in the chat that we look to see?
Yeah.
What else is catching your eye?
Maybe I can read through. And the next one that I see is, would investors not use ESG data for exclusions, penalizing non-green companies rather than incentives greening? Could you comment on how to actually create change through investments? Would that not be more PE? No, actually investing into the fixed income market is directly lending money to those organizations. So this has an immediate influence over the issuers of the fixed income instruments. And that's the most impactful way actually to drive change. And maybe that's a place to mention a very interesting and promising trend we've seen in the market with the creation and the usage and issuance of sustainable linked bonds. Many large organizations are starting to issue such bonds, which are directly linked to meeting very specific sustainability related and defined objectives and metrics. And if they're not met within the predefined timelines, then the coupons, the payments increase. So it immediately impacts the companies and provides financial incentives for the companies to meet their sustainability commitments. Impacts through the equity market
Chanel's
is a little
one of
bit
those
more
companies,
challenging.
isn't it? I think.
Sorry, Ryan?
So Andre was telling me that Chanel is one of these companies that has one of these bonds and loans linked to their sustainable performance. I think that's an amazing development.
Yeah, a number of large organizations have issued such bonds in recent months, and I agree that's a very, very promising and trend, and one to watch for, because we do expect it to grow phenomenally.
Okay.
Ryan, we had an earlier question around the role of B Corps. Tim asked this about how would you value B Corps as an approach to embedding ESG and tackling climate challenges, given that B Corps have committed to a net zero? Are they seen as attractive from an investment perspective?
I mean, I think that I will mention that it really depends who is the investor and what is their objective. If an investor is pursuing climate objectives, whether that's through again, the different mandates that they're fulfilling or products that they're designing. If that's their objective, then certainly, yes, those would be very attractive investment options. But if we are looking at sustainability more broadly speaking, then there is a lot more to be put into the mix to consider what is an attractive investment objective and what is not. It's never black and white in finance, and even more so in sustainability.
This is a question of penalizing non-green companies. Is there any sort of penalizing?
Yeah, that was the first part of the long question that I read through earlier. Again, as mentioned, there are different investment strategies that investors will adopt. Some look to penalize or avoid some industries, like exclusions, negative screening. Also used, this terminology is also used to talk about exclusions. So in this case, you're not only looking to avoid non-green companies, but investors might be looking to avoid any one industry or sector based on their values and beliefs and mandates, whether that's alcohol, tobacco, gambling, the traditional negative screening industries and approaches. That's one way, and that's the most adopted way in the market right now, actually, frankly speaking. The biggest AUM held by in the market from an ESG perspective are exclusion-based AUM, and that's changing, and I think that that's very good that it's changing, because exclusions is a way to avoid and minimize risks in some areas, but it's not a way to benefit from market opportunities generated by this shift, as well as finance the changes that are required to create more sustainable economic models in industries and businesses. So although it has worked until recent years for many investors for many reasons, that's changing, and we do see a larger portion of ESG AUM being now adopting more sophisticated approaches, whether that's true integration of ESG into investment decisions, or more identifying best-in-class companies, or engaging with companies to drive long-term value creation. So yeah, there are different approaches, and they're changing.
And I think maybe Jackie, just one last question. What's this last one? I could start investing into companies which truly embrace ESG. Into where would you point me to get going? Do you link with specific platforms for small investors? Oh, sort of the Robin Hoods and the Hargreaves Lansdowne, I guess, more retail investment. Do you have any recommendations there, Elena, as a smaller private investor, how they can feel comfortable they're investing in things that match their values?
My strongest recommendation here is do your own due diligence. There are lots of solutions available in the market, a lot of ESG branded products, funds, impact funds, asset management organizations that specialize in sustainable investing. So there is a lot of opportunities really to choose from and start with. However, do not assume that because someone is using the word sustainability or impact, it will align with your expectations and your objectives. So do your due diligence, ask the questions, make sure that your needs are accurately understood by a wealth manager if you're going to outsource it, or get someone to do it for you, or if you're going to do it yourself, then in terms of the data that you're going to use to identify the right investment options, ask the right questions. And I guess I'll just make a reflection on the ESG ratings comments that we had from earlier in the session today, and the low correlation between ESG ratings. So if you just take an ESG rating and use that as a proxy to identify the most sustainable companies to invest in, there are different nuances of ESG ratings out there. Some are more opinion-based, like equity and broker research recommendations, where you're going to have an equity research specialist providing a recommendation. The same way you're going to have ESG recommendations made by ESG analysts, and that's what you're going to get by some of the ESG vendors in the market. Others, like Refinitiv, are data-driven, factual. We don't provide recommendation. We offer data. We aggregate it automatically so that it provides signals of the ESG credentials relative to peers of any one asset or company, so that users can formulate their own opinions. And the two are very different. And the approach across ES and G is also a big factor in differentiation that needs to be considered. So ask a lot of questions, make sure that the solutions, products that you choose truly meet your objectives and needs.
Thank you. I think that's a point to finish on, Jackie. So if I can hand back across to you. And
thank you. Elena,
thank you, Elena, very much, by the way, for joining us here. We needed you on board with your expertise. Really appreciate it, particularly as you're on maternity leave.
My pleasure. And I see lots of great questions that we couldn't get to, which is unfortunate. Apologies, we're running out of time, but happy to be contacted offline and have a conversation on any of those areas. Do be conscious that I'm on maternity leave, so I may be a bit slow in replying, but I will do my best.
That's incredibly kind. Thank you. If people are getting in touch, how would you like that? Through a LinkedIn message, through an @Twitter? Yeah, either of those?
Either of those work fine.
Okay, that's really kind of you. And the insights you've just shared and the contemporary perspective is so valuable. We are incredibly grateful. Ryan, Parkinson has no worries. You were fantastic, and I'm going to have to get you to do this again sometime. That was really generous of you both. When you become the London Stock Exchange, then from Friday onwards, is there a new Twitter handle, or will Refinitiv be the same sort of thing? Because I think watching you and tracking and using that data is a really important part of keeping on top of things.
It's a really good question. To start with, everything will be as it is currently. I think we will come out the door on Monday with new email addresses, but the old ones will resolve. Social accounts will be the same, and then we will start making transitions over the coming months. It's going to take quite a while. It's going to be a big rebranding, whole new world. So
okay, so
exciting.
Yeah, enjoy your weekends, but everything will work
exactly as it is now.
Okay, that's lovely. Thank you so much. Really, really grateful. Thank you to you all. Thank you for your patience around some of our technical glitches, but we got there in the end. A reminder that tomorrow we're looking at the future of work and well-being post-COVID-19. It's actually a workshop, so there'll be much more in the breakout rooms with my colleagues Ilka and Hannes. Thursday, we've got alumnus Georgie Hazel talking about fintech, finance, futures and fairness. And on Friday, we'll get together, led by the very able facilitation of Karen Vanstone, to reflect on the week and reflect on some of the questions that we are holding as a community. Thank you very much. Thank you both again. Incredibly grateful. Take care and look after yourself wherever you are.
Thanks, everyone. Bye-bye.